It's your boy Mr. Cryptopus. Let's continue from where we left, that is on learning. So now we're going to check on trend lines, how to draw them, the rules you have to follow while drawing them, and then from there we can go to the practical part of it and also see how you can use the trading view platform for you to do the analysis. So uh, let's get into it together. Let's get into it. So trend lines, what is a trend line? What is a trend line? And a basic definition of a trend line, this is a line drawn to connect what? A series of prices through a diagonal line. That's what a trend line is. And we have another point there. Trend lines are commonly used in technical analysis to visualize and predict price movements in financial markets. They help identify the direction of a trend. It can either be drawn on the charts by connecting two or more points, so you need at least 2 points for you to call it a trend line. And we have what we call support and resistance trend lines. We have support and resistance trend lines. We'll check on that. So now let's check on importances of trend lines. Importances of trend lines. Number one is identifying trend direction. A trend is the market direction. So trend lines will help us identify the direction in which the market is moving to. Is it up, is it down, or is it sideways? Those are the only three trends we have. We have an uptrend, downtrend, and a consolidation or a sideways or a range in market. Support and resistance. Trend lines they acted as support and resistance, and most beginner traders they use support to buy and resistance to sell. You buy low and sell high, but I don't advise people to use trend lines for entries. We'll check when it comes to that. Point number three is entry and exit points. So that is the same thing as what I've just explained in point number two. You can use trend lines for you to enter the market for either a buy or a sell, right? Um, Number four is trend reversal signals. When the market comes to certain points of a trend line, it can indicate the trend is changing. If we are on an uptrend, it can indicate that we are changing now to a downtrend, or we are changing from a downtrend to an uptrend. Enhance risk management. So trend lines will help you know where you can place your stop losses, and also where you can place your take profits. If you're, let's say you are entering a buy at a trend line, you will definitely know I'll place my stop loss below that trend line. Yeah. Um, hmm. Confirmation tool, combining trend lines with indicators, Fibonacci retracements, they enhance your confidence, or they give you more confirmations. Yeah, so you need to combine trend lines with something else for you to take trades. Don't just take trades based on trend lines alone. Psychological impact. Many traders may watch key trend lines and make these levels self-fulfilling, as buying or selling pressure increases near them. So you'll see the market will intend to play with the trader psychology at various trend line levels. Or when the market approaches certain levels of trend line, you will see there is that kind of a behavior that the market will have. Now, steps to follow when drawing trend lines. Steps to follow when drawing trend lines. The first step, you define your time frame. What time frame are you going to use? Is it monthly, daily, 4 hours, or 1 hour, or 30 minutes. And for us, we do what we call top-down analysis. Top-down analysis is whereby you start analyzing from the higher time frames coming to the lower time frames. So we start with monthly time frame, weekly time frame, daily time frame, 4 hours, and then 1 hour time frame. Number two, zoom in your charts. Zoom in your charts. So you zoom in your charts, for that you can clearly see the charts. You zoom in your charts. Number three is identify the trend. Identify the market trend. And so identifying the market trend is where now you define whether is the market in an uptrend, downtrend, or in a range, or what we call a consolidation. Select key swing points. Select key swing points. You select those key swing points both on the upper side and the lower side. The upper side is where we have what we call a resistance. The lower is where we have what we call a support. So you select the key swing points or key levels. Then once you have selected them, connect them now with that line. That line is now what we call a trend line. Connect at least two significant points. So that means you need to have at least or a minimum of 2 points for the trend line to be valid. Then once you have connected that, you can extend the trend line. This is now for future price movement. For future price movement. The fifth point or step is that adjust for precision. Do adjustments. Maybe you had 2 points at the beginning, but you look on the market and see, if I move this trend line to this point, I'll have 3 or more or 4 touches. So you do what? You adjust for what? Adjust for precision. Number 6, confirm the trend line. Confirm the trend line strength. That is now based on the number of touches. How many times has the market come to that trend line and it has been rejected? It has failed to continue moving in the direction it was. If it was going up, it has failed to continue going up. If it's down, it has failed to continue going down, because now if the trend line is strong, it will be rejecting that market multiple times. And then the last one is watch for breakouts and retests. A breakout is when, now let's say we had a trend line and the market was going upwards, and then the market goes past the trend line. That is now what we are calling now a breakout. Then a retest is the market coming back to where it broke out. Let's check on the few rules that we have. Rules number 1, use at least 2 points. So you need at least, or for a valid trend line, you need at least 2 points. Follow the trend direction. So that basically means that we should draw trend lines in a trending market. A trending market is a moving market that can either be uptrend or downtrend. If the market is consolidating or inside a range, don't use trend lines. Number 3, avoid forcing trend lines. Don't force them. Don't force them. You should draw them freely. You should draw them freely. Number 4, focus on the candle bodies, not just wicks. But as for me, mostly while drawing trend lines, I focus mostly on the edges, that is not the wicks. The other one is that the more the touches, the stronger the trend line. Okay. Maintain a reasonable angle, that is between 30 degrees to 45 degrees. If you get yourself in a situation where maybe you have drawn something like a 90 degrees trend line, try and repeating that trend line, you will feel that it's like you are forcing something. So you should be free. Extend trend line into the future. We have talked about that. Avoid cutting through the candles. So don't draw a trend line that cuts across the candle bodies. About this, combined with other indicators. About the indicators, if you want to do that, you will learn that on your own. I don't use them. I've never used them, and I don't teach them as well. The last one is continuously adjust. So after the market has made significant moves, you can now adjust the trend lines so that you can move with the current market. so that you can move with the current market. We have what we call market channels. Market channels are price patterns which the market moves between two parallel trend lines. There are three main types, but okay, it's okay. We have what we call an ascending channel, an ascending channel or a bullish channel. This is now when the market is going towards the upper side, and the market will be giving you what, higher highs and higher lows, higher highs, higher lows, higher highs, higher lows. Then we have the descending channel or a bearish channel where the market is now trending towards the downside, and it will be giving you now lower highs and lower lows, lower highs and lower highs. Then we have the sideways, but for the sideways, I'll allow me to leave it. So for this, we have talked about the ascending channel where it looks like an uptrend. It's an uptrend. You can see we have higher highs and higher lows. We have the lower one is the support, the upper one is the resistance. We have what we call a contracting channel, a contracting. It is started wide, but as it continues, it's becoming a thing. That is now how a contracting channel looks like. You can clearly see. We have an expanding channel. It is started thing, but as the market continues to move, is now expanding, right? We have checked on the ascending and descending, then contracting and expanding channel. That is it. So now the last thing we are going to check before we go to the practical part is now the market trends. Market trends refers to the general direction in which a financial market or asset price is moving over a period of time. Identifying market trends is crucial for making informed decisions or trading decisions. And we have three major types of what market trends. Number one is an uptrend or a bullish trend. It indicates that buyers are dominating the market. That means buyers are strong in the market. It provides what as a buy signal. So if we are in an uptrend, we look for more buying opportunities. We look for more buying opportunities in what? In an uptrend. And how do you know that we are in an uptrend? An uptrend is characterized by a series of higher highs and higher lows. So if the market is in an uptrend, it will be giving you higher highs and higher lows. We are going to check on that practically so that you can understand it better. The second one is what we call a downtrend. A downtrend shows that sellers are now in control of the market, or sellers have more money than buyers in the market. It gives a sell signal. And then what else? In a downtrend, we look for more selling opportunities. In a downtrend, we look for more sales. The other one is that how do you know that we are in a downtrend? A downtrend is characterized by a series of lower highs and lower lows. The market will keep giving lower lows, lower highs, lower lows, lower highs. And the third one is now what we call a consolidation or a sideways market or a ranging market. It has different names. And for this, you get that neither the buyers nor the sellers have the control of the market. They are trying to each is trying much hard not to be outdone by the other. So most of the times when we are in this kind of a market situation, I highly advise people to stay out of the market, or if you are in the market, you do what we call scalping, right? You do what we call scalping because you don't know when the market breaks out of the consolidation, which direction will it follow. So that is it. How to identify market trends, use trend lines to connect signals, observe price action patterns like higher highs, higher lows. Okay, we are going to check on that. Identify price structure, higher highs and lows, lower highs and lows, trend lines. So we are going to do that right now. we will be doing that right now, and then from there